How many of you came to the county because you love math? Math. Diana likes math. Math is not, I didn't see a lot of hands go up. So, you know, some of us are numbers people, some of us aren't. But before I get started, this photo, anybody have any idea where this might be? Marilyn's right. She's got it. This is Twilla County. This is up in the mountains above Twilla County. So anyway, this is the one tree that we got to grow in Twilla County.
Not looking great.
Not looking too great. That's a south-facing slope, but that's a curl-leaf mahogany. But yeah, for those of you who love botany. But anyway, certified tax rates. Certified tax rates. This is something that everybody loves. Who can levy a property tax? Well, taxing entities. Basically anyone who, from various entities who have agreed that they're going to fund their services with the help of property taxes. There's some entities decide not to use property tax, and they might use some other funding source. We mentioned earlier, you know, we have county, school districts, cities. We have cities that decide not to assess a property tax, like Moab. Does that mean the citizens of Moab don't have to pay any property tax? No, they get to pay probably just as much as anybody else, because most of the taxes are going to be county and school districts and other things. But each of these entities can decide to whether to use property taxes as a source of funding. Talk about a couple terms in tax rates. Tax areas and taxing entities. Taxing entities are those entities which can assess a property tax. As we mentioned before, county, city, school districts, special local districts. A tax area is an area that's where all of those entities have a unique combination of overlapping taxing entities. Whenever possible, we do not use the word district to talk about tax areas, and there's a reason for this. What are some of those taxing entities called? Districts. We have school districts, we have special districts, local districts, mosquito abatement districts, my favorite. Water districts, all kinds of districts. This is a naughty word when we come to the tax area language. And whenever possible, we hope that people will refer to a tax area as a tax area when there's a overlapping group of entities that are all consistent in that area. And it creates confusion, so if we come out and we see your system refers to a tax area as a district, we'll be very nice about it, but we might say something snide. What is a tax area? We showed this slide before. Now, one of the things you need to know is this is an entry-level course, and for some of you guys, this may seem old hat, but we go through this as much redundance as possible because we really want you to understand this. The taxing, these are, show you what taxing areas are. The county, let's say the county includes all of this rectangle. Now this isn't really all that accurate because the school district just has this circle. Mosquito abatement has this circle, and special service district, D, that has that circle. So if I live right here, who can tax me? How about right here? How about here? Yeah. And here's where I live. I get taxed by everybody. Luckily, I just own a really modest little house, and I get a 45% residential exemption. But nevertheless, that is how tax areas work. Here's some examples. I'm going to pick on my home county of Tooele because they're here, and we can talk about them. Here are some tax areas in Tooele. You got tax area 1, which, and look at, we call it tax area, includes Tooele County School District, and Tooele City. Now we have a numbering system that we utilize, which is based upon this first number here, 10, 2, and 3. Counties are all 10, 10. The school districts are going to start with a 2, and the cities are all going to start with a 3. So in your particular county, it may be that Tremont in Box Elder is 3060 or something like that. In ours, Tooele City is 3050. That numbering system is important in how we count out. See Grantsville? Have you ever been to Grantsville? Anyone been to Grantsville? Cool town. I like Grantsville. 3010. That's and the mosquito abatement district in Tooele. We have mosquitoes, believe it or not, because we have water. Go to Stansbury Park sometime, you'll see that we have water. We have lots of mosquitoes. 4030, Tooele Valley Mosquito Abatement District. And so tax area 2 has these combination. Tax area 3, that's school district and Wendover City. Did you know that Wendover is in Tooele County? We have a little sliver of it in Tooele County, just across the border. All the tax base is in Nevada. That's where all the casinos are. But yeah, Tooele is Wendover. Now let's talk math. I warned you we were going to talk about math. Show you how simple we're going to start here. What is 2 times 3, Nancy? Right. See, Nancy's got it. She's on top of this. What is x? 2 times x equals 6. To solve, you basically divide 6 divided by 2 to come up with 3. This is basic math. This all sounds really simple. And this is basically how you get down to the tax rate formula at its most simplistic level. You take, you want to know what tax I pay as a homeowner. I take the value of my house times the tax rate, and that becomes what my tax is. So, if I want to know what the tax rate I paid was, I can take what I paid in my tax bill, divide it by the value, and I can calculate the rate. Again, an example. Your house is appraised at $250,000. This is nicer than my house. Like I said, I live in a modest house. I work for the state, DI. 250,000, residential exemption of 45%. So what is the taxable value? You'd take 250,000 times 1 minus the residential exemption, 50.55. You have a taxable value of 137,500. So I apply 137,000 times, say I have a tax rate of 0.015, and my tax bill comes out to $2,062.50. So if you're looking at it from a little broader perspective, in the calculation of the rate, you take the value times the rate equals the tax. So if I know my value is this, and this is my bill, I can calculate the rate back to 0.015. Again, revenue divided by value equals rate. So when you're looking at it from the taxing entity perspective, you're taking all the taxable values, not just my house, say Tooele City, all the houses and properties in Tooele City, and all the value, taxable value, it becomes the value. The budget equals what they think they're going to need to charge, what revenue they're going to need to generate from property tax. And the tax rate is basically calculated based upon those numbers. So at the very basic level, that is how the tax rate process works. I got a warning for you. It's not that simple. But at a fundamental level, it really is. The problem is that each of these entity parts, the taxable value, it's all in the detail. How you calculate the taxable values together, how you come up with the what the revenue they can get. There are adjustments that are made in this process, but at the basic level, that's how it works. So the entities, they must set an annual budget. Each of them, the city, county, mosquito abatement district, and they have to decide what portion of their budget is going to be funded from the property tax. Now, property tax statutes under 59.2 allow entities to have the same, to generate at least the same amount of revenue as they did the year before from property tax, with one caveat. And that is, if they had annexed out property, say they lost property, they could lose it, but that's a caveat there. So the tax rate is driven by the budget that the entity set. And they can always get generally the same amount of revenue as they did the year before. One thing that is not in this calculation, though, and this is an important consideration, there's no provision for cost of living increase of any kind or inflationary adjustments to the tax rate process. So essentially, an entity can get the same amount of revenue they had last year, but there's no inflationary adjustment. There is an adjustment for new growth, and we'll get to that later. I created my own district because I'm narcissistic that way, but it's something really exciting, a Swan Cemetery district. My mother is buried on Swan Drive in Twilla Cemetery, so say they have a budget of $20,000, and their tax base is pretty limited, but they have $500,000 in real property, $100,000 in personal property, and centrally assessed of $400,000. So they have a total of $1 million in tax base. So if you go back to that rate times the base equals the revenue, and you say they have a budget of $20,000, and in order to generate that, they need a rate that's you're gonna times that by that $1 million in tax base. So you divide the 20,000 by the million, and you come up with 0.02 as your tax rate. And that's how Swan Cemetery sets their tax rate. It's all driven by the revenue portion, and then the other things just fill in. The certified tax rate is in code in 59.2, 924. This is a good one to memorize and understand, and if you can make sense of the way it's organized, you're a smarter attorney than I am. But nevertheless, it's all in there, and basically it says tax rate will provide the same ad valorem property revenues for a taxing entity as were budgeted by the taxing entity for the prior tax year. The rate usually changes every year. Why would the rate change from year to year? Jill? Collection. Oh, Pat? Fluctuation of values, exactly. Pat is busy all the time adjusting values up, down, properties, personal property. What happens to personal property every year? Yeah, same asset last year is going to be worth less this year, but then new personal property comes in, and so you've got this change every year, and as a result, the tax rate. If I see the same tax rate year after year, I'm actually kind of suspicious. My auditor hat comes on and say they're fudging the numbers somewhere. So the rate usually changes every year, but the values don't stay the same. Increased values is going to lower the rate, and decreased values is going to cause an increased rate. So what happened when the market crashed back in 2008, 2009? Your assessor went out there and reappraised all these properties, and the values went down. So the tax rates went up. So what happens to a taxpayer is they say, wait a minute, my value went down. How come my taxes are about the same as last year? This isn't fair. It's important to understand this dynamic that everybody's value goes down and it causes the rates to go up. And one of the things we do at the Tax Commission is, because sometimes they don't know that the county is where to call, they ask us these kind of questions all the time. So we're assuming that you guys also get these kind of questions. So basically you take last year's budgeted revenue divided by the current year taxable property values, and the county auditor then comes up with a certified tax rate. Now, the county auditor has a lot of help in doing this because we have a system in place that helps do this. You plug in the numbers and it all comes together. Now, the certified tax rate is basically this formula, but it's done with adjustments. Remember how I told you it's not as simple as I showed you? It's those adjustments that the legislature has put in place. So basically you're taking last year's budgeted revenue adjusted for a 5-year redemption difference. What's a redemption? Nancy, do you know what a redemption is?
Those are when people come in and pay their back taxes.
Exactly, when someone pays taxes from a prior year. So basically what this means is that the legislature does not want a county to gain a windfall, or any entities to gain a windfall from just improving their collection procedures. So what they do is they take a 5-year average of redemptions and they make a difference between that 5-year average and the previous year's 5-year average, and that becomes a redemption difference adjusted to the prior year's budgeted revenue. So that last year's budgeted revenue can go up or down a little bit in this equation based upon what's happened with redemptions. And where do we get the redemption number from? Curtis? Yeah, how do we just pull that out of a hat, or?
No, that's your, isn't that basically your collection rate from the treasurer's office?
We get the redemptions from the 750 from the treasurer's office. That's why we look at that 750. And we'll talk about that a little bit more later. Now, taxable value, we make adjustments to that as well. Who has a CDRA in their county? You know what a CDRA is? Curtis, can you tell me that whole acronym, what it means?
Community development. RDA is redevelopment area. Community development renewal.
There you go. Community Development Renewal Agency is what they are. These are what people commonly refer to as redevelopments. And there's different kinds of redevelopments with different rules associated with them. And basically what they do is we take the increment value that's dedicated to that CDRA and we back that out of the taxable value for those entities. And I'm going to make this as simple as I can, but say when you create a CDRA, you start with a base value, say $50,000, and is what the land was valued at. Well, the tax increment value is any additional value that accrues to that property because of the development of the CDRA. You know, improvements, new businesses come in, and all of a sudden that $50,000 in value is now $500,000, and so you have an increment value of $450,000. We take that, we make that an adjustment against the taxable value, because that value gets taxed, but then it goes to the redevelopment agency. Board of Equalization, we take a 3-year average. It's adjusted to the taxable value. So we look at Board of Equalization adjustments during the past 3 years, and that can make a difference as well. What happened when the market crashed, for example, is there's usually about a 1-year delay in what the assessor comes up with. And so there's big fluctuations where when the market's really fast moving upwards, you have a lot of Board of Equalization hearings and you can have a lot of adjustments. And then other years where the values are dropping and you get the same kind of criteria. But if things are stable, you don't have much in terms of Board of Equalization. And so we've had the last few years, we haven't seen as big of Board of Equalization adjustments. Dean?
Does that figure in as a percentage? How do you make that adjustment?
It's the total amount. It's a 3-year average of the total amount of Board of Equalization adjustments. And collection rate. Let's talk about collection rate. We take an average of 5-year collection rate for each entity within your each taxing entity. And again, this makes a big difference in your tax rate calculation. What's really important is you look at what is that last collection rate that drops off and what is the new collection rate this year, because that can really affect your collection rate average.
Can you back up one slide?
Yeah.
So I want to make sure I understand all I know. Isn't that kind of a double whammy then with looking for the word? The 5-year redemption difference, that's people that have redeemed after they haven't paid for a while, and they're going to be a big shot. Isn't that the same thing as the collection rate? People haven't paid you and all of a sudden they pay you more? What am I missing there?
Collection rate is your current collections. Your current collections. For this year, the prior year year you're looking at. Redemptions be for prior year taxes, and so the collection rate, the redemptions is a 5-year average of what redemptions you bring in. Collection rate is the overall collection rate for the county.
Over 5 years?
Over 5 years. What your collection rate, say you got a collection rate of 90, 91, 92, et cetera. Those 5 years then become a collection rate average of, Does that make sense? Or?
It is getting better.
Yeah, okay.
It's
Oh.
less fuzzy.
All right. We hit you on all these numbers and terms right after lunch. Paul, let's see. I need a 10-year-old kid to show me how to do this again.
From current slide, top left.
Second.
Keep going left, keep going left.
Left, second one.
Oh, okay. My eyesight is so good, yeah. Anyway, so you take the collection rate average, and then the other adjustment is new growth. The one area where an entity can get additional money is if they've actually had new growth. And there's a lot of debate about how new growth is going to work in the future. And a lot of this has to do with centrally assessed property. Legislative intent was designed so that, say you have new subdivisions come in and you're putting more pressure on your schools, that you should be able to generate more revenue from property tax to pay for those schools. However, the new growth equation includes centrally assessed, and so what happens if the price of copper increases? Well, Kennecott all of a sudden increases in value, and there's a whole bunch of new growth, and all of a sudden you've got a windfall, but is there really any economic need for those particular entities? And so they take additional money, and then the next year copper drops off, but new growth doesn't go into the negative, and so what happens is entities over time can get a windfall. So we'll go into that a little bit more when we talk about the new growth calculation. And here is the new growth calculation. We basically take the locally assessed real property adjusted for reappraisal minus the prior year's locally assessed real property, including their BOE changes. Then we take the prior year's personal property and 2 prior years' personal property. We subtract that out, and then centrally assessed, current year centrally assessed minus the prior year centrally assessed, and then all of those less the CDRA adjustments. And one minus the other gets to be new growth. New growth cannot be less than 0. So we don't make an adjustment if new growth is less than 0. But if there is more than 0, it does become an adjustment against taxable value. And what that does is it pushes the tax rate up and allows the entity to collect more revenue. Because basically, by lowering the taxable value, what do? You increase the rate. So that becomes the new growth revenue that an entity is able to collect. Now here's an example. Is this big enough for you guys to see? Okay. You got a certified tax rate value of 15 million for centrally assessed, 10 million for, for real property, 10 million for centrally assessed, 5 million for personal property. So you got a total value of 30 million. Now we have to make adjustments to that taxable value. Say CDRA increment value, 350,000. Board of Equalization, 3-year average, 150,000. So you get total adjustments here of 500,000 to your taxable value. So instead of 30 million, you've got 29.5 million in taxable value. You take that and you times that by the 5-year average collection rate of 90%. We're using nice big numbers here. And we come to a proposed tax rate value of $26,550,000. Now let's say that there's new growth in this particular entity of 550,000, because I like this all to add up with lots of zeros. So we take that 550,000 out, and you got a certified tax rate value of 26 million. And from there, you're able to calculate what the tax rate is. All right, what happens if they've done their budget and they need $20,000, but the certified tax rate only is going to give them $18,000? And they in order to do the same services they did last year, they really need that $20,000 instead of $18,000. What do? They go through a process known as truth in taxation. We mentioned this earlier today, that sometimes terminology gets used that doesn't exist in code. Truth in taxation, if you can find truth in taxation in the Utah code, we'll give you all of Ruth Ann's cookies. Truth in taxation does not exist in there, but I think it probably did exist in the original bill that put this process together back in 1986. And basically what it means is that if an entity decides that they're going to have a rate above the certified tax rate, they have to go through certain provisions. They have to provide certain notifications. And it's slightly different depending on calendar year entities versus fiscal year entities. It's a little hot in here, isn't it? I'm beginning to wish I hadn't brought a coat. But anyway, Nancy, what's the difference between a calendar year entity and a fiscal year entity?
Calendar years from the 1st of January to December 31st. A fiscal can be just 365 days from the first day, so July 1st to June 30th.
Yeah. Fiscal year entities under law are under the fiscal year of July 1st through June 30th. Calendar year entities are January 1st through December 31st. Counties, what kind of entity are they? They're calendar year, that's right. What are some examples of some fiscal year entities? Cities. Yeah, school districts. School districts and cities, those are big ones. And because these rules are slightly different, we at the Tax Commission are kind of used to dealing with different disclosures processes depending on the time of the year. Basically what it comes down to is it requires a public hearing to discuss the increase, and it poses advertisement requirements for this hearing. The county auditor has coordination responsibilities, and property tax division, we provide technical assistance. In what way might we provide technical assistance, Ginger?
They're going to be the reference or the go-to person.
Yeah, exactly. Well, who puts together the ad? the clerk auditor. How do they put together? How do you create the ad though? Is there a system in place to generate that ad? The CTR site produces that ad for you. Yeah, yeah. That's one of the things we've done, and our CTR system produces that ad once you put in all the relevant data, and then you can just ship off a PDF to the newspaper and have it placed in the ad. Have the ad placed really easily. But the county auditor has some important coordination responsibilities because there's a couple things. If they're having hearings in their county, they can't be at the same time. The county and the city can't be holding, well, they wouldn't, but the city and the school district can't be having their hearing at the same time. And if there's more than one entity going through truth and taxation, they have to have a combined ad as well, in addition to the other requirements. So the county auditor gets to do a combined ad, and our system puts that together for you as well. And our quick reference guides that Josh mentioned earlier, I strongly encourage you to get to know this. This is for a calendar year entity. Shows you the whole process. By October 1st, they've got to do this, and they got 14 or more days before the general municipal election. They got to have a public meeting to talk about, with an agenda item talking about their increase, and yeah, parcel specific mailings. Those are always fun, and they're expensive. If possible, it's always nice to send those out with the tax notice if you possibly can. So anyway, it's also there for the fiscal year entity. And here's an example I want to show you. That's a really kind of a fun little example. This is an actual property tax. This is what our system produces. What's interesting about this? They had to go through truth and taxation to have the same amount of money that they did last year because of situations with redemptions and so on. Yeah, and so Midvale City is proposing to increase its property tax revenue. The Midvale City tax on 175,000 residents would increase from $59.96 to $59.96, which is $0 per year. Midvale City tax on a $175,000 business would increase from 109.03 to 109.03. We do get situations like this, and it's all because of the adjustments that can take place in that math. And in this particular case, if you're Midvale City, this is probably an easy sell to your taxpayer. It basically says your tax bill is not going to change. And if the proposed budget is approved, Midvale City would increase its property tax budgeted revenue by minus 0.21% above last year's property tax budgeted revenue. All comes down to redemptions and how that all worked out. So there are unique situations. There's a lot of moving variables in the property tax certified tax rate process. And it's like how they make sausage, when you see all those components put together sometimes. But it's very interesting if you like math and you like to see how the little component parts fit together. And being an old auditor, I kind of like this sort of stuff in a very perverse sort of way. Because scenarios come up and I have to say, why on earth did the number do this? And I have to look at all the components and how they fit together. And I usually about 4 o'clock in the afternoon, I have an aha moment, and I say, aha, that's why. Yeah. Yeah. So anyway, the certified tax rate system. This was the brainchild of one of our predecessors, but who really made this happen. And she's not here today. And this is Jennifer Conde. But Lamar Sayer, who used to be over tax rates for years and years, wanted something like this, but Jennifer was the one who really made this happen, and she's our assistant director, and She was my old budget analyst when I was at the DMV, and a very sharp young lady. And the certified tax rate system is really a remarkable system because basically what it allows you guys to do is enter the data, and it makes all the calculations for you. It allows you to produce the ads, and as a resource to look at your tax base and look at those variables that are affecting the tax rate. I think that's a really valuable resource. I love that system. I just think it's remarkable. She was recently given an award for the governor's, what do they call it? Governors for Excellence or something like that, you know, for her work on that. It really is remarkable compared to the way it used to be. If there's any old timers here who can tell me what it was, can remember what it used to be like. I was in property tax division back in the 90s. And we had basically Kerry Chapman working with a bunch of spreadsheets and Dave Vanier, and they did some voodoo and somehow came up with tax rates. And what we can do now is so much better and so much more simple. It's really remarkable. So I hope you get to know the system as much as possible. Josh is going to give a demonstration of the system. After I'm done. I think you're getting a break though, aren't you? Are they?
Yeah, break and then
Okay. But before we do this, we're going to go through some of the important reports that we file on there. County filed reports, the auditor year end. We already talked about this one. What's important about the auditor year end, there's a couple things. It was filed by the county auditor. It's due January 31st. We use that as the basis for the personal property value for the coming year. That becomes part of the 697. It's also used to produce the Board of Equalization adjustment. Treasurer 750, it's filed by the county treasurer, due March 31st. We're going to push that back, we think, and we'd really love the auditor and the treasurer to do this at about the same time so their numbers are exactly the same. So we don't try to figure out why that there's a disparity between those numbers. That's used to produce the collection rate and redemptions. Sum of value, 697. This is what's being worked on right now.
You notice that says it's filed by the assessor?
Yeah, that's my mistake.
Should
It's
be filled out by.
filled out by the assessor, yeah. Usually under the assessor or the auditor, depending on the county. But ultimately, it's the auditor's responsibility to make sure it gets in. And so that's an error on my part there. But a lot of assessors do it, but ultimately the auditor is the one that certifies the rates. So now we also have some other information reports we require, tax relief filed by the auditor and Pac-Man 233X. I'm not going to go through those. Auditor 233 year end used to produce the Board of Equalization. Data is gathered by tax area. And real and centrally assessed is used as baseline in new growth equation. And the personal property value becomes the basis for current year's 697 value. This is a little small, but you've got a handout. This is Beaver. We pick on Beaver all the time because they're first in the alphabet. Sorry, Ginger. And here's the Treasurer 750. It's data gathered by tax entity. And it's used to calculate the collection rate. Using 5-year average, shows how closely the budgeted revenue was to the actual revenue collected. We look at this comparison of what the budgeted revenue was and actually what was collected because we want to see how effective the certified rate is. Because if the certified tax rate says it's going to come up with budgeted revenue of $2 million and they come up with $2.4 million or $1.6 million, then we know there's something wrong with the numbers, and we know there's something we need to look at. So that's one of those things we do, is we look to see how effective the certified tax rate process is, because one of the values of property tax is its stability. That's why Utah uses the property tax so heavily in the first place, is because, first of all, we have lots of kids. You might have noticed that. We have sometimes we get a lot of criticism for not spending a lot of money on education per pupil. But the reality is, as a percentage of our income in Utah, we spend a high amount of money on education because of the number of kids we have. And because we don't want, they generally do not want our education to be dependent upon whether the economy was good or bad in a particular year. They have relied heavily on the property tax. But we want to make sure that this process generates about the amount of revenue that it says it's going to generate.
Okay, how much of a percentage is okay off from what you budgeted?
It depends. You know, we recognize that there's going to be situations that are going to occur that are explainable. And we're going to say, okay, we understand why. And I'll give you a really good example. And this is happening right now in some entities. The last collection rate to drop off was from the years that collection rate was extremely low. What was the collection rate like this year? It was a very high collection rate this year. The economy's doing well. People are paying their taxes. So the collection rate dropped off as low and collection rate is high. What would you expect to happen? So you're basing the tax rate on a 5-year average collection rate that's being dragged down by a low value. So we are expecting, and we are in fact seeing, that budgeted revenue is lower than the actual revenue received. And we're seeing that a lot. And if you have some small entity where you've had a large taxpayer who wasn't paying, and there's an example in Wasatch County, or is it, maybe it's Summit. Summit's the one I'm thinking. Summit was one where they had like a 46% collection rate drop off, and they got like an 80% added on. And so what happened is, all of a sudden their budgeted revenue was here, and they collected up here. These are the kind of things we see because of that collection rate anomalies, and the fact that sometimes collection rates can deviate a lot for a small entity that has a limited tax base. So to say it depends, I know that sounds like a real weasel word, but so long as we can explain it, you know, and we know what's happened and why, you know, but if it's really deviation and we can't really figure out why, then we wonder whether or not there has been some math errors that have taken place in the distribution and stuff. So, anyway, this is an example of the 750. 697, basically you're taking the current year values as of January 1st, with the exception of personal property, which is always 1 year behind. And that comes from the 233B. Important reappraisal numbers in the 697. Very important to look at. If we don't see any reappraisal numbers, we usually wonder one thing. Did the assessor forget to input anything, or is the assessor playing games with us to get new growth? Normally, there is going to be some reappraisal work that's done in every county. And so reappraisal is an adjustment in the new growth calculation. So if there's actually been reappraisal, but it's not coded as reappraisal, a county or an entity can gain a windfall by doing so. And so we're very nervous about that if we don't see any kind of reappraisal activity in a particular county for a particular entity and so on. So we look at the reappraisal numbers. Does it make sense? We're seeing the market increase, and there's a decrease, you know, in reappraisal. You know, those are things we look at. We look at CDRA increment values. You know, those are things to look at. Because the numbers become the basis for certified tax rate value. So anyway, there's a whole bunch of things we look at with 697. Here's an example of it. Ruth Ann mentioned this, but coordination and cooperation is just absolutely essential. It's really important that counties don't operate in silos, and that, you know, what's really bad is if there's a blood feud going on. You know, between the treasurer, the auditor, or the assessor. It's really important that they all work together, because each is dependent upon each other to make sure that they get the numbers in a timely fashion, and that they're communicating important information on you know, any changes in tax areas and et cetera. So, you know, the auditor takes the lead in a lot of this process, but they're all really important players in the process. You know, the auditor really needs to know all the taxing entities involved, who their key players are. Because every year, they're gonna be setting proposed rates. And each county does it differently. Usually, for some counties, each entity has a contact person who has a log-on with our certified tax rate system. And once the county auditor certifies the tax rates, they have to go in and either accept the proposed rate or put in a proposed rate that's higher than the proposed rate and go through truth in taxation. It comes down to the auditor calling and saying, are you okay with this? And they basically, the auditor puts in the tax rate, so.
Okay, Marilyn has a question.
Oh, Marilyn?
Just never having done this before, does it list all of those entities for you so you make sure you don't miss any of them?
Yes, it does.
Or does?
Yep, in fact, Josh is going to walk you through the system, and on the 693 screen, he'll show you exactly how to look at every single taxing entity in your particular county. And because that's really important in the process, you know, going forward, is you're going to need to know, you know, some of them just call the entity and say, is this okay? And then the auditor goes in and puts the number. It's different from every county. Okay, what is our role? Basically, we calculate and set certain tax rates. The basic school levy. We have to, once we get all those values in, we have to calculate a basic school levy, which is basis for a lot of the, you know, the money that goes to the school districts. Equalized entities. Central Utah Water Project, CUP. How many counties are they in? Are they in your county? How many of you get CUP, Central Utah Water Conservancy? Yancy? Buff is Wasatch? Weber Basin Water? Anyone get Weber Basin Water? Yeah. So there's a bunch of entities that cross county borders, and basically what we do is we come up with a equalized entity rate. So, you know, we do our best to approve and do our best to verify the numbers. Because mistakes are made, you know, there's data entry mistakes, there's pulling the wrong reports. So we do a gut check. You see, if we see a number that seems awfully high or awfully low, seems out of place, we are going to call you and ask you, and that's when Josh calls Pat and gives Pat a hard time and says, how come this number is so low? And then Pat grumbles and says, my number's right, Josh. Believe me. No, or he might say, there was a new business that moved into this particular location. You know, those are the kind of things we do. We want to make sure the numbers are right, because if they're not right, it can throw off a new growth calculation. It can also cause tax rates to move in a direction we don't want, and it can cause it can cause the entity to get less revenue than they budgeted for, and that can be a real hardship on particular entities. So we try to help out and make sure, you know, there aren't any errors in there, but ultimately it's the county's responsibility to make sure those numbers are right. But we do our best to verify the numbers, and if we ask questions, don't take it personally. We treat everybody the same. We're obnoxious to everybody. So